Hey, good morning, everyone. Marty Mazzora here with a very brief midweek market snapshot. I'll start, as I've been doing of late, just giving you a brief narrative, and then we'll spend just a minute or two on the charts. Not a whole lot to talk about today. You might think there'd be with the events over the weekend, tragic, heart-wrenching events. On behalf of what we do here at PWA, we have to look at things from an economic and a financial perspective. We saw what most would consider a pretty big pop in energy prices. I guess in the grand scheme of things, relative to what it could have been, maybe a little bit muted. It's coming back down, notably today. At least we're seeing it in energy stocks that we have in our core portfolio. On one end, it just adds to the uncertainty in the world that ultimately translates into, this thought that economies and markets hate uncertainty. Therefore, the uncertainty and what that implies would be something that would inspire Fed officials to come out as they have the last few days and begun to signal that they're probably done with the rate hikes. Recently, we've taken that position that not only are they probably done, they really should be done. They've probably done plenty. Our recession signal is still flashing pretty bright red. Economists who weren't in the recession camp, by and large, now are in the recession camp. Despite the positive action in the market of late, as I wrote to you, or when I shared the intro to our internal equity market conditions index that we update monthly, I said an October rally should come as no surprise. Sentiment had gotten quite sour, and as I illustrated in the video that I shot Thursday night and shared with clients Friday morning, the technicals, I'll go through that in a minute, we're looking relatively positive. I was leaning towards a rally, but I did suggest that if the jobs number were hot on Friday, markets would hate it. That's how it turned out. The headline jobs number came in very hot. Stocks rolled over pretty hard, at least in the pre-market, and then in the open, I think the S&P was down over 1%. NASDAQ was down like 1.5%, which is a pretty good decline over a very short period of time. Made perfect sense. I did write in the morning when the market was still rolling over that, when you look through the headline, you see lower than expected wage growth. And that's really where folks who are worried about inflation, and that's really what we're talking about right now in terms of how the markets are trading, might view that as a positive. And I noted that precious metals, and the one that to really watch would be gold, were actually in the green, even though bonds were rolling over. So something in the precious metals market was seemingly already looking through perhaps into the numbers. Plus the household survey, which is where they get their unemployment rate, came in under expectations at 86,000 new jobs versus the 300, and I think it was 36 from the Bureau of Labor Statistics. So mixed message, but you could actually go through it and say, it wasn't really all that strong after all. The revisions that were pretty impressive for the prior 2 months, 100% of those came from government, primarily state governments. And you actually had a $12,000 negative revision in the private sector. And then the market actually turned right around and rallied throughout the rest of the day. So that was an interesting dynamic. So you could say, well, the technicals actually were right. And I'll, again, update those for you here in a second because I was leaning towards a rally. So again, as we kind of suggested, we kind of set expectations for at least the early part of October. Could look pretty good. And frankly, when you look at the fact that softening economic conditions are actually bullish for stocks, traders and investors in the aggregate really have this notion that a bad economy or a weak economy is good for stocks because virtually their entire focus is simply on the Fed. The fundamental problem, and folks, we've kind of hit this one really hard, and 2 weeks ago I showed you 60 years of economic and market history, and we've made this case right from the get-go. First leg down, as long as there's no recession, we thought 3,500 on the S&P Technically, our technical analysis said that's where the market bottoms, and that's where we will load up the truck, because we've been pretty defensive all in all when you look at the hedging and you look at our cash position and other things. But if when we get there, our recession signal is flashing, which it was, then it's going to go lower, but it's probably going to bounce. So we're still in that bounce. Ironically, a year ago today, or this month, Bloomberg's economic team gave a recession 12 months out a 100% probability. And obviously we've been in that recession camp based on our own indicator, and it didn't happen. Now you look back and you say, well, why didn't it happen? Well, pandemic savings were greater than what people anticipated, and people had the mood to spend. Yes, manufacturing's been in recession, but the consumer has kept things alive. Now, as I've shared with you over the last few weeks, the consumer credit performance is waning, higher delinquencies on credit cards and auto loans and so forth. They seem to be spending money more on staples than on discretionary. And when you look at the surveys, hardly anybody is saying they're going to be spending more over the next 6 months. They're actually saying they're going to be spending less. And as I heard one commentator on Bloomberg this morning make the accurate statement that even if they spend the same, it's not a good thing. It's going to be worse because of inflation. Now, when we hit recession, that's a whole different story. So at the end of the day, while technically, as I'm going to show you, the market doesn't look so bad, sentiment got pretty bad, which means the market doesn't look so bad. If things improve and we get weaker data and everybody still thinks it's all about the Fed, well, then you've got money on the bear side of the boat that can rush over to the bull side and bid stocks higher. As of yesterday, though, advisor sentiment actually got much more bullish than it's been, so that migration is moved. We'll get the individual investor sentiment here in the next day or so. And then we have another half a dozen, kind of market internal sentiment indicators that make up our own fear-greed index. And it's been pointing over to the fear column, which again is bullish when you can bring other factors into play. So, long story short, sure, we actually could recapture those gains that we had by the end of July that we pretty much gave up in the third quarter in the fourth quarter, right? And that's great if it happens, but in our view, it's neither here nor there. This is not a time to be stretching to try to capture gains in markets. Until conditions get better, this is a time, yes, to be in the market so you can capture, gains as they happen, but to be hedged, either through diversification, through having defensive kind of recession, I don't want to say proof, but asset classes we've moved up, certainly in terms of our allocation to consumer staples and healthcare. Our core portfolio, we're just a little more than half equities, lots of short-term cash, money market, which is great because you can get 5% right now, which we are. And then, gold is the biggest chunk. Gold and ag commodities are the two biggest chunks in our commodity exposure, which make up the other 20%. There's about 10% in bonds right now. Bonds are looking more and more compelling. We added to our long-term bond position. Anyway, at the end of the day, sure, we could see the market rally a little further. It's interesting. I've seen some of the strategists who I respect the most get suddenly very bearish and very short the market. I think that's interesting because right now, I don't know. I don't know that it's time, but ultimately I do think that time comes, or at least odds favor that. And right now, we want to focus more on positioning to not get creamed in a precipitous market sell-off. In fact, quite the opposite, to have lots of firepower to begin scaling in to the areas that I've kind of illustrated for you of late that we are really, really bullish on a longer-term basis. We think that the macro investment opportunities are notable for the next bull market. And if you didn't catch last Friday's blog post, I really want you to, clients in particular, because I give you some history and what we're thinking and our view of the dollar and all these things that kind of build our thesis. We will always stay diversified. I don't think we'll be hedging as aggressively as we are, if at all, in the options going into the next bull market, but we got to get through this cycle right now, and we got to spend that money on protection. It's just what you really need to do under these conditions. Okay, so folks, I will leave it there. For those of you who don't want to go through the technicals, those of you who do, I'm just going to kind of rush through it really quick. And so in front of you is the hourly chart, which is where we started last time on the S&P 500. And recall that, I said at least on the very short-term chart, this was a bullish setup. So I'd drawn that, and we were sitting about in here, and I said that makes sense. We had these very bullish divergences, and I said, well, the jobs number could definitely kill this. This is looking pretty bullish, and you can see what we've done right since then, right? And then on the daily chart, we had kind of a classic bear flag look here that has completely failed, right? Survived a test of the 200-day moving average about 4 times, and as of this morning, we're actually popped up here above the 20-day moving average. And oh, by the way, I forgot to talk about this in the narrative. Producer price index came out today, and it was actually a little hotter than expected. You go through the numbers though, and a lot of that was energy related, and it doesn't always comport with CPI, which comes out tomorrow. And apparently some of the evidence in there suggests that companies may not be passing on the price increases that they're seeing to the consumer to the extent that they have of late. And so that could portend for a relatively soft CPI tomorrow. And keep in mind, though, folks, things that the market would rally on right now are not the things that ultimately fundamental sound investing concept would have it rallying on. Meaning soft economic data that ultimately leads to recession means that stocks are too expensive because they're priced for earnings to just keep going up and up and up. And that is not, unequivocally, that is not what's going to happen during a recession. So the short-term traders are either just thinking very short-term, and like I am in this narrative, about the short-term potential for the market and expect to get out in time, or they're just frankly not being smart about how they're thinking about risk right here. But anyway, on the daily chart, we have, a not bearish look, right? I did tell you we didn't have the kind of bullish divergences that we normally look for, right? But we do have a buy signal right here on the MACD coming from a very low position, so that's bullish. Coming off of oversold territory right here, breaking above that 200-day moving average. We get a soft CPI print, and we could see more upside during the month of October. So we'll see how that plays out. And then just quickly on the daily, on the NASDAQ, again, bear flag. Boy, that looked compelling. I mean, the market, I think, ultimately does come down and probably more than tests the 200-day moving average, but this bear flag pattern just is not playing out. And the NASDAQ has now recaptured the 50-day moving average. That's pretty bullish as well, running against that 370 resistance. And you got this, you weren't oversold here, but you were close. You do have your buy signal on the MACD, so not a horrible technical look. This would reverse super fast if we get a hot CPI number tomorrow. I don't know how it's going to come in. Base effects actually support a higher number when you look at it year over year. Month over month is what you should be looking at, and if it comes in as expected on a month basis, then you're going to have a soft enough year-on-year basis to bring more people into the markets. But please heed what I say about the kinds of things, I'm going to be very redundant, that has the market rallying right now confirms our broader thesis that says the economy is really not in good shape at the end of the day. And more evidence is going to continue to mount as we meander into the weeks and months to come. Folks, thank you so much, as always, for watching and listening. And I'll be back tomorrow with something on the written blog, and then, of course, at the end of the week with the economic update. Take care. Bye-bye.